It's 2025. AI stocks are mooning, Bitcoin just cleared $100,000, and the median U.S. home costs 6.7 times the average income. The least affordable level in history. People are acting like risk disappeared. Spoiler, it didn't. Because before every crash, history flashes warning signs like a neon billboard. Today, we're breaking down 5 things that almost always happen before the market tanks. And number 4, that's the cruel joke Wall Street never tells you. Let's go. Number 1, the "it's never been safer" illusion. Right before a crash, everyone feels invincible. In 1929, economists said stocks had reached a permanently high plateau. 2 years later, the Dow was down 89%. In 2006, people swore housing never goes down. By 2009, U.S. home prices had dropped 33% nationwide. Entire neighborhoods in Las Vegas and Florida looked like ghost towns. And today, AI stocks. Nvidia's price-to-earnings ratio recently hit 75, more expensive than dot-com darlings in the late 90s. People are calling it the new electricity, which coincidentally is exactly what they said about the internet in 1999, right before the Nasdaq lost 76% of its value. But it's not just the illusion of safety. It's when everyone from your grandma to your Uber driver suddenly thinks they're an investing genius. Number 2, everyone and their dog is talking about it. 1630s. Holland. Tulip bulbs cost as much as 5 years of salary. Everyone wanted in. By 1637, prices collapsed by 90% in weeks. 1999. Barbers, cab drivers, even shoeshine boys were handing out dot-com stock tips. Amazon survived, but half of all tech IPOs from 1999 to 2000 were bankrupt within 3 years. 2017, Bitcoin hit $20,000. By the end of 2018, it was down 84%. And in 2025, TikTok is flooded with teenagers promising to retire by 30 with AI ETFs. Your cousin, who once asked if Netflix mailed VHS tapes, now calls himself a crypto strategist. Herd mentality is loud, cozy, and deadly. And when the herd is hyped, there's always one rallying cry they cling to. Number 3, buy the dip. Mania? Every downturn starts with brave voices shouting, "Buy the dip!" And for a while, it works. During the dot-com crash, investors kept doubling down. But after the Nasdaq fell 76%, most bailed. In 2008, people swore housing would bounce. Instead, 6 million families lost their homes to foreclosure. In 2022, Bitcoin fell from $69,000 to $16,000, and the HODL army went silent. And right now, every 5% AI pullback gets spun as a discount. But history shows optimism fades fast when losses snowball. Buy the dip eventually mutates into sell before I lose it all. Which brings us to the cruelest twist in all of investing. Number 4, the cruel joke. Nothing always happens. Here's the brutal truth. There is no single guaranteed warning sign before a crash. 1929, fueled by 10-to-1 leverage and zero regulation. 1987, a computer trading feedback loop that tanked stocks 22% in a single day. 2008, subprime mortgages hidden inside complex derivatives. $8 trillion in wealth vanished. 2020, a virus shut the global economy in 2 weeks, triggering the fastest 30% crash in history. Each collapse had different triggers. What rhymes? Overvaluation, speculation, herd mentality, and way too much debt. Look at today. The Buffett indicator, total U.S. market cap to GDP, is 170%, far above the 140% danger zone. Corporate debt is at a record $13 trillion. Student debt tops $1.7 trillion. And household credit card debt just crossed $1 trillion with 20% interest rates. That's a lot of skinny dipping when Buffett's tide goes out. And when it does go out, it all ends the same way, with panic selling. Number 5, capitulation at the bottom. Capitulation is where investors wave the white flag. It's ugly, but it's also the point where fortunes are made. In 1932, after an 89% drop, most investors quit. That was the exact bottom. In March 2009, the S&P 500 hit 666, down 57% from its peak. Headlines screamed, "End of capitalism." That day marked the start of a decade-long bull run. In March 2020, as COVID shut everything down, the market bottomed and then roared back, with the S&P up 70% within a year. Here's the irony. The bottom always feels hopeless, but it's usually the best time to buy. It's like a Black Friday sale where everything's 90% off, but instead of shopping, everyone's sprinting for the exit. So here's the truth. Crashes can't be predicted. There's no alarm bell, no flashing sign that says, "Get out now." But the patterns, overconfidence, herd hype, dip mania, cruel unpredictability, and capitulation, they rhyme every time. The winners aren't the ones who call the crash. They're the ones who prepare by diversifying, managing risk, and keeping cool while everyone else panics. If this video gave you clarity, smash that like button so YouTube knows you're smarter than the herd. And subscribe for more economic history breakdowns, from tulip mania to AI mania. Because trust me, the next story, it's just as wild.